Howdy traders, welcome back to the channel, and if you're new here, my name is Yager Avon. I do videos about stock trading, technical analysis, I talk about my day trading business, all that sort of stuff. So today we're going to be talking about a very interesting set of indicators for intraday trading. This is going to be using a combination of the PSAR, the parabolic support and resistance, along with the Supertrend indicator. This is going to give you a pretty useful trend inside of trend scalping mechanism, and I'm going to break it down for you, how it works. Then I'm going to go run about 100 back tests, and we're going to cover the results, and we'll find out if it's a useful strategy that may be employable to us in one way or another. So the way it works is very simple. You have a longer term trend, which is the super trend, and you have a short term trend, which is the parabolic support and resistance. When it's a general uptrend, a large one, you want to be taking PSARs in the upward direction, not the downward direction, the upward direction, the upward direction. We've combined this with the Heikin-Ashi bars for better trend reading and a little bit of smoothing added to our price. And with that, I'm going to get testing here. Oh, before I begin, here, let me show you. I've developed a brand new piece of software. Now I've spent hours of my life and millions of dollars developing the UI and complicated technology behind it, and I want to show it to you now. Boom. Highly advanced technology. We're going to be using this for our back testing. I developed it myself inside of licensed software. Yeah. Very, very advanced. Without further ado, alright guys, I'm back with the back test, and you can see it was a fairly decent strategy, a fairly decent test on it. We ran back about 33 days, or just under 13,000 1-minute bars to get the 100 trades. So that means that honestly we had to wait a little while. At 1-minute bars, at only about 3 trades per day, you did a lot more waiting than you did trading. That's true from a lot of these selective strategies where you're trying to get, the smaller trends inside of a bigger trend. You're not going to be in it for a majority of the time. You're actually going to be a small minority of the time, which can be a drawback. Because at the end of the day, trading is about making money. So if you spend a lot of your time waiting, not a lot of your time trading, even if you have a great strategy, it can be slow to roll, right? At the same time, another thing I noticed was this was a relatively trendy period. And if you ran this sort of back test on either a different market or a less trendy period, I'm sure you'd have less trendy results. Maybe even wait longer or more time. It would take you, say, 40 days or 50 days to get 100 sample. What we can see by looking at this is it has a decent win-to-loss ratio, about 1.4, which is fine when you're winning more than half your trades like it was. What about 7 and 10, but again, this is a pretty trendy period. And it wouldn't be very surprising to me if in more choppy periods that dropped down to 50-50 or even less. And maybe your average win, average loss would, kind of flatten out as well. So it probably might be a scratcher and, more consolidated markets or things that are choppier and less trendy. But what it does do a good job of doing is getting trends on both sides, nailing both bearish and bullish trends in its operation. But it does have some healthy drawdowns. You can see in the chart here, there were a couple of spots where we got a good number of consecutive losses. And again, those are periods where the market's chopping back and forth, and really either trend, bullish or bearish, is not going very far. So every trend inside of those trends doesn't go very far. But when the market is trendy, we can put up a good series of large wins in a row. So, all in all, I mean, depending on how you run things and what exactly your game plan is as far as risk management and stuff, I could see this working if you have a way to, if you're only looking at very volatile markets or you're trying to only go after active tickers, stuff like that, things that probably aren't going to spend too much time consolidating. It can be relatively solid. At the same time, you spend a lot of time waiting. And it has a lot of big wins. So the problem with that is you kind of have to be on the ball all the time it's really easy to miss one or two big wins with a strategy like this and just mess the whole thing up. Just ruin your average win because you missed like one or two big ones. And even if your winning percentage stays the same, your P&L might get toasted. So, yeah. Anyways, I hope you guys learned something. If it's something you want to, look at for yourself, the strategies are all easily available on TradingView. And running a backtest to me is relatively easy. You can just kind of at least on this one, I could code half of it. I could code the entries. I couldn't code all the exits. So at least half of it was semi-automated, so it really wasn't that time-consuming, let's say. But if you have any questions on how to do that or anything you've seen here, make sure to put them in the comments. I'd be happy to answer them for you. And I hope you guys have a wonderful day and enjoy the video.